today we're going to discuss Powell QT and why this isn't 2007.
Yeah, so I went through 2007, and this is nothing like it, not even close. So in 2007, there were all these things that were going on before, and mostly the big issue then was home prices, right? Home prices dropped significantly. So
in 2008 they dropped.
Or 2007, 2008. They started in 2007, you're right. But 8, 9, 10, it just kept going, right? And so what really, the big difference between then and now are home prices. And so right now, people have a lot of equity, like trillions of dollars of equity. I think last time I looked, it was well over $1 trillion of sitting equity in their homes. Whereas back then, they called it mailbox money, jingle mail. The jingle mail is when they would just mail the keys back to the bank.
Yeah.
Because there's no reason to keep it.
Yep. And then Powell right now is, as we talked about earlier, is starting to ease on quantitative tightening. So that is going to be interesting for the market as well. It was a big announcement.
Yeah. So let me just outline real quick. So you guys probably heard of the U.S. Treasury. So the U.S. Treasury, they print dollars and mint coins. So that's what they do. That's the stuff you probably have in your wallet or at home or whatever. The Fed, when they talk about money printing, it's not actually really printing. There's QE and QT. Quantitative easing, quantitative tightening. And so, when the Fed chair throws these around, it actually means something, right? Like, so when Powell said this week, his exact words were, some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates along with more noticeable but temporary pressures on selected dates. And our long-term plan is to stop balance sheet runoff. And that's actually the big issue, when reserves are somewhat above the level we judge consistent with ample reserve. So what that means is that they're going to pause on quantitative tightening. And so what that's going to do is it's actually going to increase the money supply. And that unfortunately makes bonds rise and potentially makes interest rates also, interest rates, go up and down. So it's going to be really interesting to see what happens with this, because we don't know whether or not he's going to move to QE or he's just going to put pause, right?
Yeah, and I think that's the question that he doesn't know the answer to yet either, right? Are they going to have to start printing money again, or are they going to, and buying bonds and different things, or is the market going to kind of work itself out? But why it does matter is, interest rates have not went down as the Fed has lowered, their rates because of some of this quantitative tightening. So now that they're loosening that up in the market and they're not going to be holding on to bonds anymore, it will be interesting if they, if that affects interest rates, because that could push rates down.
Right. So they'll stop buying is what they'll do, right? And they'll stop putting reserves in the banks, and that's going to shrink their balance sheet. And so that's essentially what QT means.
Yep.
And so essentially, in theory, it kind of takes money out of the economy. Now, that has...
Well, explain that, though, because it's not really taking money out.
Well,
what it's doing
true.
is it's just
less money for banks to lend, right? Because they're increasing the bank's reserves, right? Or they're pulling it out, right? So that's essentially what they're doing, is they're trying to intentionally slow down the economy. That's what it means. And why would they do that? So he went further into the statement, and he said that the interest rates, he believes are actually in a pretty good spot, but labor, unemployment, he's a little worried about. He said it, and of course inflation. What he said was it's still above their target. So in his mind, unemployment potentially is creeping up or could creep up, and the inflation is above the target. So those are two things, and that's why he said the QT stuff.
Right, because there's going to be less bonds to, essentially, as the Fed is dumping, letting the bonds mature when they were quantitative tightening, that affects the bond market. So now that they're not going to be letting anything else mature under their books right now, they're not going to be buying anything, they're not letting anything mature, that should help the bond market, which in theory could help the rates.
Yeah, so the one way to look at it is quantitative easing is buying bonds, and they're buying assets and they're increasing the money supply, right? Essentially, that's what. And then tightening means that they stop, right? So or sell off, and so that's essentially what it is. And so each one has a corresponding relationship. So when quantitative easing, the bonds rise and interest rates go down. So that's what's interesting about this, because he said QT, and then
he's stopping to QT.
Well, he's stopping QT, yeah,
right? So
right.
That was a big thing with the banks. This weekend is they had to borrow money from the repo market because there's not enough money supply, and that is what happens with QT. So that is part of the reason. If they ease up on that, that will liquidate more money for them to lend. And
then a really good website for you guys to watch is found. It's called CME Group. Is that right, Jerry? CME Group? Yeah, CME Group Fed Watch. So just go look at that. Here it is. Thanks, Jerry. So the probability of the Fed lowering, coming up is at 0.25% is in this particular chart. It's almost 100%. So last I looked, it was like 89%. So it even went up. And as you guys probably know, the Fed's meeting on the 28th and 29th. But I also want to point out that that's just one piece of the story, right? So that's the federal funds rate. And Jerry, do you have that quantitative, or do you have the money supply? There you go. So let's take a look at this real quick. I think so. This is the M2, or the money supply, and you can kind of see where it kind of peaked up in 2022 and then went down, and now it's kind of on its way up again. So this is just something to watch. I think it's a really interesting thing to watch as we start to, I guess, inject or pull liquidity out of the market, and then this one is the total assets, and this is another really, really good one. As you can see, they've been doing this for a while, and obviously when it peaked up there, we were at 9.1% inflation, I think was when it was at its peak, and then you guys got to see the interest rates go up. Which was essentially what they were trying to do, and obviously drove it back down. So Trump's been beating on the Fed, of course, to try to get these rates down. The one interesting thing is, as we were talking about earlier, the commercial markets are really more focused on the 10-year Treasury, right? And that's the one. Those are the ones that we watch. I'm not saying we don't watch the federal funds rate, but the 10-year, there you go. There's your 10-year. So right now it's at 3.9. That's today. It was actually over 4 this morning. So that's a very important indicator, and this is a direct reflection of potentially the lending, the refinancing of the multifamily, commercial office, retail, and a lot of that stuff, and of course more than that. But the 10-year Treasury is a really, really, really good indicator. Ironically, even though it shows that it's on its way down here, the forecast is actually that it's not going to really move that much. If you take a look, from 3.9 to 4.1, while that is significant, especially on millions and millions of dollars, it's just bouncing there in less than 1%. And so it looks like a lot, and it is, and it's super helpful. But this is on a 6-month. Why don't you hit it on the 1 year, Jerry, which is right down there below. So you can kind of see, we were there not long ago, and the beginning of the year. So it's just coming back down to where it was, and I think this is I know this is gonna help, because there's a lot of commercial multifamily folks, people that are in these debt maturities. We're hitting that debt wall. You guys have all heard about that. It's like $1.5 trillion of maturing debt, all coming due by the end of next year. So, however, they're not really projecting that this is going to go down much further because of the same issues that Powell talked about, which was the labor market and inflation. Those are the two things that are kind of the wild cards still.
So everyone's kind of wondering, with this quantitative tightening ending and then potentially quantitative easing starting, we don't know, what's going to happen with the housing market, because a lot of times people associate these kind of things with a crash in the housing market, and they look back to 2007 and kind of think that we're in a similar situation. So Ken and I wanted to go through and look at how people were vetted for loans in 2007 versus, 2020 and beyond, because at the end of of the day, in order for a market to crash, you need people in distress. And there's a lot of differences between 2007 and now. So the first thing we wanted to talk about was the average credit score in 2007 in order to get a loan versus now.
689.
Yeah, 689 versus
715.
715. And
not that much difference, really. A little bit.
That's a difference, but the average mortgage borrower right now, so 715 is just what you need in order to get a loan. The average mortgage borrower right now is a 736, which is a pretty high credit score.
So it was a little looser back then, right? Like you could fog a mirror and get a place. I just want to say one thing that I think is kind of funny. I don't know anybody that went through 2008 that is actually saying we're in 2008. Like, you know what I mean? Like it's just hysterical. Like all my friends, right? We went through it. Like I remember, like this is 15, 16, 17 years ago. That was brutal. And none of us are saying this is like 2008. It's only the people that go back and read. Like, you know what I mean? You have to actually feel it. You have to know what it was like. And we're not even close, in my opinion.
Right. And then you have to look at the debt to income as well, because that's the other way they qualify for a loan. And then many loans back in 2007 were 50 to 60% debt to income. And right now you're at about 36 to 38 debt to income on most loans.
Yeah, the borrowers are not stretched at this point. Like, just think about, like, you can actually lose your job. There's all kinds of stuff that can be happening right now with the economy. But when you got a lot of equity in your house, like you do feel a little bit more comfortable.
Yeah.
Right? You can sell it. It might not be, what you want to sell it for right now, maybe, but the reality is it's like having a savings account that's sitting in your house. That did not exist in 2008 for most people.
Yep. And I think the biggest one is this loan to value with reserves. In 2007, a lot of them did 0 down loans, 100% financing, where nowadays people are putting 3 to 20% down. And realistically, I'm seeing, 5 to 20%. Yeah. I mean, 3% is
I think they called them no doc loans back then. I remember no doc. No doc means no documents. Like, come on. Like, really?
Self-declared credit.
Like, I'm gonna self-declare that I'm good to, lend millions and millions of dollars out. That's essentially what happened. So no surprise that bubble burst.
But it all kind of goes together, right? Because if you have a lower down payment, then your, debt to income ratio is affected as well. So they're all really connected. So, nowadays what I'm seeing buyers struggle with is they actually have to put down a decent amount because of that debt to income ratio. You have to be able to make that payment every month. And then back in 2007, people really were just buying homes to sell them for more the next year. And a lot of times, that had worked in the previous times before that. And, so they weren't really worried about those monthly payments. They'd figure it out until they could sell the loan. And since they didn't have to declare anything, everybody was kind of just being approved.
Yeah, and I also, let's just not talk about only the borrowers. Obviously, you guys, like it's essentially like you getting a credit card with 0 interest, right? And just going out and hoping that whatever you use that on went up. Well, it didn't. And so, eventually you still owe that. And so it was kind of that was going on during that period of time. Made a lot of people rich. A lot of people that did it correctly and used that, they did fine. A lot of people did not. But I think the banks also have learned a lot from that period of time, because the banks are not in the business to own real estate. They're in the business to use it as collateral and borrow against it at a hedge, at 65% loan to value, 70% loan to value, and that's how they mitigate their risk, is the collateral against whatever they're loaning against. So a lot of the rules have changed. I can't remember is it the Glass-Steagall Act? I think maybe I could be. Maybe I just pulled it out of where. But I do remember there was a whole bunch of stuff that got passed after, all these banking issues, because you could literally fog a mirror and get a loan. And people, they did.
Yeah, and the subprime mortgages were really big then. Right now, we're seeing a lot of fixed rate mortgages. We're seing a lot of rate buy downs, but those typically still set to the market rate when they're done. But in this subprime, category, you were having these balloon loans where they would go up significantly overnight. And that really is what triggered everything, is people could not make they were planned to sell the home before this happened. They couldn't sell the home, and then they couldn't afford the payment. And they had nothing down, so they walked away.
And I would just be careful right now, guys, because you're starting to see the banks actually, banks, when they're not lending to, they get they hurt profitably as well. So you're starting to see these loans out there that are ARMs, adjustable rates and floaters and stuff like that. And I'm not saying that there isn't a time to use it, but just remember that what goes up can also go down. So everybody's banking on rates going down. So if you guys are in the market right now and you're looking at these adjustables, you might want to get a price on a fixed too, because you can always refinance on the way down. Don't forget. So, so what you're going to see is you're going to see some very different pricing. And you might get a way better deal for an adjustable, but just remember the risk, because that's actually what got people into trouble right now is they did that a couple of years ago, and now rates are more. And so you just because that the CME Group, Market Watch, and Fed Watch is saying it's 99%, that's just one indicator. Just be careful. I still, on our apartment deals, we're still doing fixed rate, period. I want to know my mortgage next year, the year after, the year after. I want certainty. So I can't caution you enough just to be careful.
And now a word from our sponsor.
Near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold paid in physical gold without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So the other thing that's really important is the household leverage. So in 2007, debt to income was 129% on average. Right now it's 82%.
Debt to income 129%.
You have to remember that right now, homeowners that have owned homes that are in these low rates, they're not struggling. So the people that might be struggling are the people that have bought the last couple of years, or the people that have not bought yet. But, the debt to income, because of these low interest rates, which is a big portion of people's, monthly spend, is putting them in a good position.
Yeah, and don't forget, guys, we've talked about this. There was a tidal wave going on in 05, 06, 07. I was in the middle of, and it was overbuilding, right? These low rates were also being utilized by the builders. And so when you have this massive supply hitting, you get disruption. And this was generally, just go take a look. Ironically, this is kind of the last time that we had this kind of overbuilding issue with single family, by the way. Right now, we have that in multifamily. We had over 500,000 units delivered this year in the U.S. And so what does that mean? What that means is you're getting 1 month free, 2 months free, 3 months free. It's good for the consumer, good for the renter. And so you have that little window right now, if you're a renter, to renegotiate and get really good deals, because of the amount of construction that was started a couple of years ago is hitting the market today. So that was what was going on in 07. So we had all this product hit the market, and it just completely overwhelmed. And then, of course, people started to default, and then things went off the rails.
Yep, that's exactly what happened. And, the investor behavior is very different now, too. Now you have a lot of institutional, you have a lot of cash flow investors. Back then, it was a ton of flippers. And we saw this a little in 2020. And even now, flippers are, there are some flippers in trouble. But back then, it was basically a ton of flippers.
Yeah, you made a deal with a flipper this week.
I did. Yep. Yeah, got a smoking deal.
That real quick, because this is exactly the way you should be looking at the market. Danille understood that this person, when they bought it, how much they put into it, what they listed it for, how long it was on the market, and so she went like an assassin. Like, tell them about it. It was a pretty good little deal you did.
Yeah, so they bought the deal for $660, right, in Phoenix or Scottsdale, great place, and they flipped it, put all really nice things in it, listed it for $975. It's been on the market 151 days, and they just lowered it to $869, which, if I had to guess, they're trying to get out of it and they're lowering it to their bottom line. And then I worked with my client and we put in an offer for $839.
And they took it.
And we negotiated it, but we ended up at $839.
That's $150,000 less.
It's $100, and that's their profit, though. They lost money or broke even.
This
basically.
is my point. So basically, you've got a renovated place.
Yeah,
you didn't have to do any of the work.
Right.
And that's again, like, people are saying, oh, there's no deals out there. That is by the way, that's not the first one that you've done like this, right?
No, I always think flipper homes right now that are sitting. That they're in most likely a high interest rate, hard money loan, and they need to get rid of it, and if it's sitting, we always say this is not a distressed market, but there are distressed sellers in the market, and flippers are distressed sellers in a lot of cases right now.
So the way flipping works is you've a lot of your flippers out there, as you guys know. Sometimes you're using an investor, a line of credit, or whatever it is, but usually it's a high interest rate, right? So you're paying that from the moment you start, and so you not only have the renovation costs, but you have the time. And so as time goes on, in this particular case, it was listed for 4, 5, 6 months. Mm-hmm. That time is just chipping away from your profit. The interest on whatever you borrowed is chipping away as your profit. So they're calculating every single month a certain number off of whatever profit they've got. So that's why I thought you did a pretty good job. And again, doesn't mean this is a distressed market. It was a distressed seller.
But back in 2008, there was a lot of those because so many people could get loans and so many people were underwater that, you had a lot of flippers and a lot of new inventory. 2020, it was still harder to get those loans, even if you were a flipper. So you have less of that, but you still have some of that.
Yeah, and it was the other thing is it's very different. When I was buying real estate back in 4, 5, 6, 7, 8, there wasn't really a value add, market, because value add only works if the market is way above what you're buying it for. So, that happened later. That happened after everything got repriced. So, that happened in 9, 10, 11, and 12. When the real estate came down way below, then people are like, oh man, I can now do a value add and ride that market back up. So what she's talking about is people are still buying, older places, dumping a little bit of cash in and trying to get the value add. Mm-hmm. So in 07 and 8, that was not a thing. I'm just letting you know. Value add was also kind of a new thing. There's a time when you can get it and there's a time when you can't get it. But what was happening back then was mostly home building. And so people were getting into newer product, and those products, a lot of that product is 10, 15, 20 years old now. And so that's the difference, I think, one of the big differences.
Mm-hmm. And so, let's go back to this quantitative, ending quantitative tightening and what that kind of means. So when you end quantitative tightening, you're basically going to stabilize yields. And because of that, mortgage rates may fall. Because right now, they've been propped up by the 10-year and everything else. If this all starts to stabilize, which is what Powell's hoping for, it could allow mortgage rates to drop.
Yeah, and again, when he says that they're done with QT, because that's essentially what he said, they're trying to slow things down. I think that's a really important thing to just wrap your head around. And why would they do that? Because inflation is a little bit above their target, and they're concerned about unemployment going up. And so when they're slowing things down, they're reducing the size of their balance sheet. And that's essentially, so it takes money out of the economy, essentially. So that's a way to look at it. And it'll be very, very interesting to see what happens, because when you quantitative ease, the opposite happens. That's when you start buying. And that's when you start buying assets, from the commercial banks. And then you put money back in, and there's more money, and the more money being lent and all that kind of stuff. And typically that's when bonds rise and interest rates go down. So this is going to be a really interesting meeting. And at the end of October. And then, of course, they meet again in December. And by the way, guys, as you guys all know, we all want rates to go down. And so I'm going to go out on a limb here. I'm going to say a 1/4 point down this month and another quarter point the first part of December. So the 1/2 point. And that's going to bring us into the threes, into the high threes for the federal funds rate, right? 3.75 to 4, I think. At the end of the month. So that's going to be great for everyone. It's going to be great for title companies. It's going to be great for realtors. It's going to be great for mortgage companies. It's going to be great for people sitting on equity in their homes. That extra little 1/4 or 1/2 point is going to be good for the economy, and hopefully we can get some liquidity going here in this last fourth quarter and push us into the next year.
And we shall see. So we'll see you guys next week.
See you guys.